Apple's up more than 6% right now. Google about 3%, but Dell, Intel, Research Motion, and Microsoft are all to the upside. Look how strong.
Did not disappoint. 400 points higher. Yes, indeed. The market's roar higher.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
In the late 2000s, the global economy experienced one of the most severe crises in modern history. The 2008 recession, also known as the global financial crisis, had far-reaching consequences that impacted individuals, businesses, and governments around the world. The roots of the 2008 recession can be traced back to the United States housing market and the subsequent collapse of the subprime mortgage industry. In the years leading up to the crisis, lax lending practices allowed many individuals with low creditworthiness to obtain mortgages, often with adjustable interest rates. This led to a housing bubble as property prices soared and financial institutions bundled these risky mortgages into complex financial products known as mortgage-backed securities. As housing prices started to decline, borrowers began defaulting on their mortgages, triggering a domino effect. Financial institutions, heavily exposed to these mortgage-backed securities, faced significant losses and liquidity issues. The crisis spread rapidly as major banks and financial institutions found themselves on the brink of collapse. The interconnectedness of the global financial system became evident as the crisis transcended national borders. Trouble in the US housing market rippled through the global economy, affecting banks and investors worldwide. Complex financial instruments tied to subprime mortgages contaminated the balance sheets of financial institutions globally, leading to a crisis of confidence and a freezing of credit markets. In response to the escalating crisis, governments and central banks worldwide initiated various measures to stabilize the financial system. In the United States, the Troubled Asset Relief Program, TARP for short, was introduced, allowing the government to inject funds into troubled banks and financial institutions. Central banks also implemented aggressive monetary policies, including slashing interest rates and providing liquidity support to encourage lending and restore confidence. Despite these efforts, the impact of the recession was felt globally. Stock markets plummeted, unemployment rates soared, and consumer spending plummeted. The crisis caused a significant loss of wealth for individuals and businesses, leading to a contraction in economic activity. Governments faced mounting pressure to address the crisis and prevent a deeper and prolonged recession. Over time, governments and central banks continued to implement policies aimed at stabilizing the economy and restoring confidence. Gradually, the global economy began to recover, albeit slowly and unevenly. Governments introduced fiscal stimulus packages aimed at boosting demand and providing support to struggling sectors. Central banks maintained accommodative monetary policies, keeping interest rates low and providing liquidity to encourage lending and economic growth. The road to recovery was challenging, with some countries experiencing a prolonged period of economic stagnation. Unemployment remained high, and businesses struggled to regain their footing. Governments faced the daunting task of balancing the need for short-term stimulus with long-term fiscal sustainability. The 2008 recession highlighted fundamental flaws in the financial system, including the excessive risk-taking, inadequate regulation, and flawed incentive structures. The crisis promoted widespread calls for financial reform and tighter oversight to prevent a similar meltdown in the future. Governments and international organizations initiated regulatory reforms such as the Dodd-Frank Wall Street Reform and Consumer Protection Act in the United States and the Basel III framework globally to enhance financial stability and improve risk management practices. Additionally, the crisis exposed the vulnerability of interconnected global financial markets and the need for better cooperation among regulators and central banks. The G20 countries played a crucial role in coordinating policy responses and implementing measures to address the systematic risks posed by the crisis. The 2008 recession ultimately came to an end, but its effects continued to be felt long after. Governments and international organizations focused on regulatory reforms to prevent a similar crisis in the future. Measures such as a stricter oversight of financial institutions, improved risk management, and enhanced consumer protection were implemented to enhance financial stability and prevent excessive risk-taking.